Good morning. Welcome to the XM.com weekly market update. And joining me again is Peter McGuire, the CEO of XM. Good morning, Peter.
Good morning, Andrew.
Welcome. Aussie CPI came out 3.4%, coming down, but not as much as what the RBA would like.
No, exactly. And they certainly wanted it far lower than what was represented. And I think that year-on-year number is interesting in its own self. But what we've seen in the first quarter was a different matter altogether.
Yeah.
And hopefully we've got a slide to decide that or to explain that. But yes, where we roll, Aussie dollar, what happens as far as our exports and of course to consumption here, high rental yields, and we don't want high energy prices, and they're certainly a lot higher or hotter than what they were going back 6 months.
Yeah, and it's sort of interesting. That's just a year-on-year figure, but the quarterly number for the CPI was actually 1%.
That's right.
Which is way too high.
Yeah, where they wanted 0.7.
So it really, the RBA has got their hands tied at the moment, where they either have to leave rates where they are and hopefully inflation doesn't spike again.
And I'll tell you what, it's going to be a very interesting winter for us in Northern Hemisphere summer, and what banks are going to do as far as central bank are we going to see, and you've got Bank of Japan today, are we going to see some sort of movement from their forecast as far as rate cuts? Do any go the other way and look rate hikes? How does the BOJ play? How do certainly Bank of England, and what happens as far as the Fed and the Eurozone?
Yeah. And speaking of Japan, the CPI numbers have just come out at 1.6%. They were expecting 2.4%. So it's sort of there in the opposite situation, really. So the CPI is very weak there, which is good for them.
And a weak yen.
Well, you look at the yen now.
34-year, and it's been a glory trade really from the start of January onwards at 140. It's up the best part of 10 or 11%, and all our traders are just rubbing their hands with glee. It's just been one-way traffic, as that chart really demonstrates. So Andrew, let's see how it rolls today, whether we see some form of movement from the BOJ. But even as you said, if you see another 0.1%, really, what's that going to do?
Doesn't do anything.
Because you've got a very weak yen, as we know, at 34-year low, but you've got an incredibly hot equity market.
Yes.
It's up 31%. You've got the topics up. The topics 50 or the topics 100, I made reference to it yesterday, is nearly up 40% in the year. That's on fire.
Yeah. So
that's Japanese stock market.
That's right.
TOPIX.
Yes. UK CPI as well come up. Once again, coming down, which is good for them, but still pretty sticky.
Very.
And you've got an economy which is not travelling that well.
No.
And once again, with the strength of the US dollar, the British pound is still under pressure.
Yep, it is. It's been very much range bound. If you're looking at that chart compared to the yen, you've got the start of the year and it's running at around about that 126.5 handle, Andrew. Now it's, as you see there on the chart, 125. You've had that sell off to 124, up to 128. It's been choppy. If you were looking at option strategies, straddle, strangles, condors, all those sort of exotic derivative strategies, it's been a tight market to trade versus what you've seen, that explosive move in the yen, and that's why all the traders have just been absolutely, gangbusters into it. Mrs. Watanabe and the yen traders.
So US GDP overnight, 1.6%. They're expecting quite a bit higher.
Yeah.
So are we starting to see
a pullback?
Some sign of weakness in the US, which hasn't been there for quite some time?
No.
Is this the start of that?
Well, Jamie Dimon came out and said, it's still very strong and this and that in the US economy and the consumption's going. I think he spoke overnight, but he did say, but if we fall into recession, or he did mention the recession word, maybe he knows the mail a little bit better than everyone else. But, that's not a good sign, Andrew, leading into summer.
But interestingly, with the earnings seasons underway, all the banks have reported, all their numbers were pretty solid.
Yeah.
And with interest rates where they are and likely to stay that way for quite some time, that's good for the banks.
100% it is.
With their net interest income, the difference between the loans and the deposits is right up their alley, and that's reflected in their share prices at the moment.
Absolutely. I mean, I've got to agree with you there, but when you look at the gross domestic product of the nation is a different matter to the performance of the banks, because that's the hurt and the strength of that consumer nationwide. And how it is over the summer period is going to be fascinating. And what leads that is to, if you have a continuation as far as softness and it'll be interesting to see it going forward. Do we fall into a stagflationary environment, which is very, very soft, if anything, nearly negative growth and still high inflation?
Yeah, that's right. But interestingly, you've got GDP coming off there, and we've got PCE prices which have just come out overnight and they've spiked again.
Yes.
So we got these sort of the push and the pull of the market.
Well, that's
at the
the
moment,
stagflationary
where
that can worry you tremendously.
That's right. So
I mean, that's not a good sign. I'm not here to alarm anyone, but just study that chart because that tells a story. Everyone thought that we'd seen some sort of pullback as far as inflation in those, February, March sort of feel, but you had the spike in energy prices and there you are, 3.4, 3.5%. It's not a good sign.
So,
yep.
Finally, Bank of America put out this chart as well, which is a survey of fund managers on no landing, hard landing, soft landing. So obviously, if you go back 12, 15 months, everyone was talking hard landing, recession, etc.
100%.
Obviously, that hasn't happened.
No.
So,
which is good.
Which is a good thing. But looking at that chart, the expectations there of a hard landing have dropped significantly. Now, once again, they are fund managers, so they've got a certain position on all of this as well.
And a certain pay packet as well.
They certainly have. So,
and the other side of it is that's till March 24. I'd like to see this moving forward. And what we'll do is try and roll it in every month, this chart. That's till March. It'd be interesting to see. We're too early for April. But whether those impacts as far as your GDP and what you saw as far as that spike of inflation, whether they're changing their rhetoric for April. So stay tuned, viewers. We will keep that, rolling forward. It's a cracker.
So it might take, I
6
suspect,
weeks.
A few months for that to change, because being in the midst of earnings season, we can touch more on earnings season next week. Obviously,
I think so.
Microsoft and Google last night had some incredible numbers.
Oh, shot the ball out of the park.
And Meta had some incredible numbers. The dialogue from Mark Zuckerberg wasn't great, but then you can't deny the numbers. So
can't deny the numbers.
But I think something like this would take probably quite a few months to change.
Yes, sentiment.
On the back of what could be a solid earnings season again.
Yeah.
So,
well, that's right. I mean, these guys they've got their sentiment, and it's got to really start to bite to get a different viewpoint. Because there's a lot of emotion in how you read that. I'm saying the guys that are, the fund managers, their own emotion is involved in it because they're looking at the equity markets. They're looking through a different lens to the guy that's just lost his job and been downsized.
Yes. No, and I think the fund managers
or lady,
they might have been heavily into fixed income in the last 12 months. A lot of them probably have been, and they've obviously missed the equity boat.
Yeah.
So because the equity market,
they mightn't have a job.
No, the equity market's come back slightly at the moment. There's a lot of volatility, to be fair, but if you haven't been in equities in the last 12 months, then
where have you been?
Your returns aren't great.
No. Or if you've been in the Russell 2000, you've picked 1,800 of the poor stocks, whereas if you picked 7 of the big ones, as we know, the Magnificent 7 or the Sexy 6, wow.
Yeah, well, that's what I think. Could be the 6 fairly soon, couldn't it?
Could be even 5.
Yeah, the way Tesla's going. But anyway, we'll keep an eye on that, but we'll touch more on earnings next week because there's plenty going on. So plenty of volatility. Plenty of movement.
Yeah, I mean, just a couple of things. First off, since we last spoke, gold's off $100. That's interesting. Silver's had a big pushback. Copper's up. It's nearly at 10,000 a metric ton, and there's been underinvestment in that whole field. There's a great article in Bloomberg for everyone out there. You should read it just in today's Bloomberg. Go online, Bloomberg Markets. The other side, I think we've got to be conscious of what happens as BOJ, and do we see a big move in the yen today?
That's right.
And how's that going to impact as far as the Asian/UK markets or Euro markets tonight, and then certainly US? So it could be if it comes out, what time is it released our time?
I believe it's 2 p.m. our time.
Okay, so that's about noon Tokyo.
Correct. Yep.
So hold on to your hats.
Yeah, keep an eye on that as well, and we'll catch up again next week.
I'll look forward to it.
Great, thanks, Pete.
See you, Andrew.
And that's the XM.com weekly market update.